Hello, hello. Hey,
Hey,
Pip, how's it going?
how's it going?
Good, man. Just getting all set up here. I changed this so I have to let people in manually now because a lot of people were having a hard time getting in. So now I gotta manually pay attention. Trying to
That's
work.
always tough.
I know
Hopefully,
it's supposed to like ding me when some people comes in, but I tried it last week and it did okay, but we'll see how it goes. So
yeah, hopefully you have a sidekick that can like keep you can make somebody like a what you would call it, co-host or whatever.
yeah, I have my wife, but my wife's driving back from swimming right now with the kids, so she's not really able to do that. So we gotta figure it out because that's why I had it originally so that people can let themselves in, but they had to match their registration to their email, and it was causing a lot of problems for people. So
Yeah,
this makes it a little easier for people to get in, but now I gotta pay attention. So let me
gotcha.
get the YouTube going real quick. We got Dre. How's it going, buddy? Just
What's
just
up?
just talk to you.
Yeah, yeah. I was chatting with you and I realized that you had something going on. So I'm like, you know what? Let me jump in here real quick. All of that sounds very interesting. So
Nice.
just don't
Yeah.
put me in the hot seat. I'm not prepared with any questions, nor did I check out the episode 13. So
No, it's all good. I'm just gonna go over some stuff here that we like some unique like lending opportunities that a lot of people don't know about. So
cool.
I'm just let me get this YouTube thing going and then we'll get going. Huh. I don't know. The going live for some reason is not working, so I'll have to post this later. I don't it usually works. Okay, that's all right. Okay. So today we're going to go over some unique loan products that a lot of people haven't heard of. And if you guys go back and listen to episode 13, we kind of go over some of these, but I wanted to just talk and give people a chance to kind of ask questions on these because um, most people have never heard of a lot of these. I know a lot of people are like working on scaling up and kind of some of you have multiple properties, some of you kind of getting going, but I know we got kind of a little bit of everybody that's in here. So what I wanted to start with is let me switch this screen right here. Okay. What I wanted to kind of start with is what's called a family opportunity mortgage. And what this is, so everybody knows if you're buying a primary, you can get, there's an FHA loan you can get with 3.5%. And there's some first time buyer programs you can get with 5% down. Um, but after you buy your first primary, it's like, what do you do? What do you do then? If you're going to buy an investment property, you usually got to come up with like 25% down. If you're doing a DSCR or traditional investment loan. So it gets a little tricky because you run out of cash really fast if you're trying to scale up. So what we do is we figure out ways to buy properties without having as much down to get into. Now, we live in California. I know some of you guys are in more expensive markets, some of you are not, but California is, a regular 3 or 4 bedroom fixer upper home is over $1 million. So you got to have a few $100,000 to buy it as an investment property, and it gets very difficult. We have talked about how we do it. We buy as a primary, and then we'll renovate that, pull money out on that one, and then move that into the next one. But you do end up moving a lot, so that doesn't always work for everybody. And we're probably going to start slowing down on that because now we have 4 kids, so that makes it a lot harder. So one of the things is a family opportunity mortgage, and we actually were working on doing this for one of our family members. But the family opportunity mortgage allows you to be able to buy a property for, say, an elderly parent, somebody that maybe is on a fixed income and they wouldn't qualify for a home on their own merit, but you can actually do this family opportunity mortgage, you can buy it as if it was a primary for yourself, but you can have your elderly family member live in that home to satisfy the primary residence requirements. So it allows you to be able to buy a property that they're going to use for now, and then once they pass, then you've got another property that you own, but you're able to get into it with only 5% down, as if it was a primary that you were buying. You just are using a family member to satisfy that primary residence requirement. So I've just heard about this about a year and a half ago, and I've never heard anybody talk about it. It's been around for a long time, but I don't think there's a lot of people that know about that. We have Laura and I have our well, my in-laws have the last several years been paying for their mother, and they were renting the entire time and paying probably more in rent than they could have been paying for a mortgage. So had they known about this program, they could have, bought something 10, 15 years ago with very little down and probably, double, tripled the price on that asset when that person passed, which they actually recently passed, unfortunately. But they would have this asset that probably would have tripled in price in that time. So a lot of people, say they don't have the extra money for down payment or this or that, but this gives you an opportunity to be able to buy as a primary residence and get that. So it's 5% down is pretty pretty good. It's hard to come by unless it's your primary residence. So this is just another exclusion or a way to get around that. Any questions on that one?
Your PMI?
So that is actually a good question. I have not done one of these yet, and I don't know if it has PMI or not. It is a Fannie Mae backed loan, but it is not an FHA. So it probably has PMI, but I don't know for sure. The next one I'm going to talk about doesn't, but the Family Opportunity Mortgage, I would think probably would. But again, I don't know too much of the specifics, so you'd have to look into that one just because I haven't done that loan before. Okay, so the next one, and this is one that is super interesting. Has anyone ever heard of the Vendy loan program? So the Vendy is for VA. Well, actually, let me back up here. Before we get into that, another option that is not talked about a lot, which I'm actually super shocked about, especially in the interest rate environment we're in right now, is a VA loans, FHA, and FDA loans. All three of these loans are assumable loans. So what that means is if let's say somebody bought a property in 2022 and they've got like a 3% or 3.5% interest rate locked in on that. They've only held the property for a couple years. So they've still got, 27, 28 years left on that loan. All of those loans, those three loans, all three of those are assumable by a new buyer. So what that means is you can assume that existing loan with the existing terms remaining. So same interest rate, same length of loan time left. So if there's 27 years left, you would assume the loan with 27 years left at the amount that they currently owe. So it's not like a subject to we'll talk a little about later on, but it's similar because you are assuming those loan terms, but the loan actually gets moved over into your name. So you're actually taking over the loan in your name, and you're just taking over those terms that they locked in 3 years ago. One of the reasons this is not talked about a whole lot is because a lot of people have a lot of equity. So it's not great if somebody has, half, they owe 50% what their home is worth, because what happens is you're assuming the loan that's existing, let's say it's $1 million home, and they've got a loan from, 4 or 5 years ago, and it's only 500,000. You're only assuming the 500,000. So there's a $500,000 delta. You got to come up with that difference. You got to either pay them cash, or you can, roll it over from another property if you have a HELOC, or get a second loan. So you do have to pay the difference on it. But one, you could get a lower rate to carry that half of it, but it works better in situations where there's not as much equity, because there's not as much equity you're having to pay out on. We've seen this in a lot of VA loans out here in California. There's a lot of VA markets. And so we've seen a few of these. We actually had some friends that were working on doing one of these. I think that deal ended up falling through, but they were trying to assume the loan. Now you do have to qualify with the loan assumption. So you do have to go through a whole qualification process as if you were buying a home yourself. But you're able to do that with, again, the VA, FHA, or FDA loans. All of those are 100% assumable. And even with the VAs, you do not have to be a veteran to qualify to assume a VA loan. Anybody can assume that, civilian or VA. The only stipulation on a VA loan is that if somebody assumes a VA loan and the person that's assuming it is not a veteran, it still ties up the oh my goodness, I'm forgetting the word, the whatever the allowable VA portion is, because the way the VA works is you have like I can't think of the word right now, but they give you a certain amount. It's like 700,000 of VA allotment, I guess. It still ties it up for that veteran that originally had that loan. So that's the only stipulation on that, is that they would be tying up that allotment, but they're not responsible for the loan because the loan fully transfers over to whoever assumes it. So that's another good tool to be able to use. So if you are looking at buying a property, this probably, and I don't know if you can assume a loan as an investment property. This may have to be a primary, because I have not done a loan assumption, but you may you have to look into it and see if if it has to be a primary or not, because you do have to qualify for the loan coming in. So it'd be like the only possible stipulation on that one. But there's this,
What about a second home?
so I don't know. You have to look into like the specifics on that. I don't know. And they might vary a little bit between the VA, the FHA, and the FDA, and every loan. And it's possible they could have different stipulations between lenders, because anybody can do an FHA. It's not just one bank that's doing FHA or VA loans. There's different lenders, so they might have their own criteria. But if you're looking at properties, and you look up and see, and you can look this, if you guys use PropStream, we use PropStream to do all of our data research. If you're looking at a property, you can look to see who has the loan. It'll tell you if it's FHA or a VA or FDA loan. So you can find out ahead of time and be like, ooh, and like software like PropStream will actually tell you what the estimated rate on that loan is. It's not 100% accurate because it's guesstimation, but they guess based on the average rate at the time the loan was written. So it gets pretty close on what it probably is, and it also will estimate what the current loan payoff is, what the actual amount on the loan is. Again, it's a guesstimation because it's based on, this is what the payment would be and this is how many payments they've made. So it kind of like calculates what it possibly could be. So don't take that as hard truth, but it'll give you kind of an idea of how much might be available to assume. So that's a good tool to kind of find those. And when you're using those tools, you can actually find VA loans. You can look for VA properties that have that, or you can probably search by FHA. I know we've done with VA, but you can probably search specifically by FHA as well. Anybody here done a loan assumption? We've done subject to and wraps and things. I haven't done an assumption yet, but we're actually going to be looking at that for this next properties that we buy in California, because we are timing wise, somebody's got something from the last few years. There's a good chance they got a really good rate on it, or I guess prior to 2 years ago. Okay, so this next one I want to talk about, this is the one that's like super intriguing. So there's this program it's called a Vendee loan. It's VENDEE. And what these are VA foreclosures. So again, these are VA loans. These have been foreclosed on. They are now bank owned, and they now do seller finance on these. So what the bank does is they will actually take these loans or take these properties, and they will, instead of just selling it on the open market, they will sell it directly to people and do the financing on it. And because it's a Vendee, through this Vendee program, they have special terms locked in on this. Let me actually pull, I have an email from one of the underwriter or one of the loan officers that does these. Okay, here it is. Okay, so for these loans, basically the overall program is that One, you do not have to be a VA. You don't have to be a veteran. So anybody can buy these. You can be a VA or you can be a civilian. Anybody can come in and buy these. If you are buying one of these properties as a primary residence, they offer 100% financing. So these are zero down loans from a bank with standard bank terms. Um, there is a there are closing costs. You're probably going to have, like 3 to 5% closing costs, whatever the standard would be. Um, the closing costs are slightly higher because they do have a VA funding fee, which is about 2%, or maybe a little more, maybe 2.25. There is a VA funding fee, which is on all VA loans, but because this is a VA program, they do have the VA funding fee that gets added in, but you can also roll that into the loan. So you don't have to come up with that upfront. You can finance that in. If you are a veteran, the VA fund is actually waived. But for anybody that's not a veteran, you do have to pay this funding fee. So here's the interesting thing. So if it's a primary residence, it's zero down, 100% financing. If you're buying this as an investment property, which they do allow, you can get this with 5% down. So they will actually do 95% financing on an investment property. And I don't know any bank that will do 95% financing. So this is like a pretty incredible program. With the investment property, there's a couple stipulations. One is that you can't put it into an LLC. So you do have to buy it in your primary name, and it has to be a rental property. You can't flip these. You have to hold it for 2 years. After 2 years, you could refinance and put it into an LLC, or you could sell it. You could do whatever you want at that point in time. But this does give you the opportunity to be able to buy rental properties at 5% down. I've talked to them about this. There's no limit on how many you can have with them. So if you like dig into this strategy, there's no, like I said, you can have as many as you want. You do have to qualify with your personal income. So it does take your personal DTI into consideration when looking at this to qualify for the loan. And then with the property, you can also use, if you're buying as an investor, you can use up to 75% of the long-term rent estimates to qualify for the loan. So you can use that into your DTI calculation. This one does not have, so there's no lender title policy required, which is kind of crazy. No PMI, no minimum credit score. You can get a 15-year or a 30-year term. No appraisal required because this is the bank that already owns it, so they don't really care. They just want it off their books, but it's optional if you want to get your own appraiser. Investors must close in the individual name and remain throughout ownership. But I believe that's for the life of the loan. So if you refinanced it out of this loan, then you could put it into an LLC or whatever you want. Rates, rates were really competitive. I think they were like when I talked to them, I want to say they were slightly lower than what like going mortgage rates were. So it's a really good loan program. Let me see if I can pull up the website here. You guys have any questions on that one? Here, I'm going to post this in the chat right here. So this is the website for the Vendy loans. So if you go to this website, you can search your area and see what's available. So they do have, when a new property gets foreclosed on and goes on this website, I believe it's a 30-day period where it's only available for primary residences. You can't buy as an investment property, but after 30 days, then they'll open it up for investments or investors. And not everything on the website qualifies for this program. I'm not sure what qualifies them or when they qualify, but what I've been told is that when there is the main photo on the website has the Vendy logo and it'll say Vendy like a watermark in the corner. When it has that watermark on the picture, that means that it's ready to go and been qualified for this program. I've looked at this in California. There's not there's a few in Orange County that pop up here and there. Usually it's kind of the outskirts and small towns outside of the metro areas, or if they pop up, they go really fast. But there's like thousands of properties on here throughout the US. So there's tons of properties on here that you can go through and check out. My brother was the one, he's a veteran. He's the one that originally told me about this. And there's a couple that he's looked at. He hasn't closed on one yet, but there's a couple that he's found in his area and he's actually made offers and tried to close on these. He just hasn't closed on one. We've found that the realtors aren't real responsive on these deals because they do have a local realtor that contracts with the bank. So you do have to talk to the realtor that actually has the listing, I guess if you want to call it a listing. But they tend to not be super responsive. I don't know why. Maybe they're not making much on these. I don't know, but they are a little tougher to get a hold of and get through on these. So you just got to kind of be quick on it. All right. Any questions on that? Okay. So one of the other things I wanted to go over before we get into more creative finance stuff is well, let's see, there's a lot of grants and programs out there that people may not be aware of. One of them is, let me pull up and see what this is called. It's through City National Bank. And I believe City National Bank is they're a California bank. Let's see, City National, what is it called? They have this grant right now. Ladder Up, there it is. Okay. So City National Bank has the Ladder Up Home Loan Grant. And this one's going to be for primary residence, so you do have to move into this one. But this one, let me drop this into the chat. Oh, that was a big link. Anyway, that goes straight to it. So City National Bank has this grant. If it's a primary residence, they will give you up to $20,000 towards a down payment. Again, it's got to be a primary residence, but $20,000. It was 50, but they ran out of funds really fast. Now it's 20,000. The reason that they do this is they actually got sued for discriminating on where they were putting their banks. I guess they were putting them in high net worth areas and weren't diversifying their locations. So they got sued by the state of California. And as part of their settlement, instead of paying a bunch of fines, they ended up offering this program. And it's not everywhere. It's California. Let's see, California, New Jersey. I think there's one other market it works in too. You have to go in here and look at the locations it works for. I want to say that there's 3 states that it works in. And you do have to do the loan through them. So, I mean, they're getting business out of this. Home loan grant benefits. Here's the benefits. No mortgage insurance. So you can do this with 3% down payments as low as 3%, no mortgage insurance, and a grant up to $20,000 to be used for down payment, closing costs, buying down the rate. Available in select markets. Let's scroll down. So you can use on 1 to 4 units. So it can be used up to a quadplex as long as you are moving into one of those units. I don't know. They're not making it easy to find the markets. I know for sure California and New Jersey, and I'm pretty sure there's at least a third market. I just don't remember, and they're not making it easy to find. So, but there's also a lot of other grants out there too. I know California did one of these a couple years ago. Oh, here we go. California, New York, and New Jersey. So those three states is what they're offering it in currently. There's also a lot of other programs like this. California did this a couple years, maybe 2 years ago, where they did. I can't remember what it was called. It was like home loan for all or home loan for everyone or something like that. And they did where you could get as long as it was a primary, they would actually buy part of your equity. They would give you, I think it was up to $50,000, or it might even been more than that, um, as a down payment. But instead of it being a grant, it was a portion of your equity that they would take. So they would, if they were paying 5%, they would take 5% of your equity, and they owned 5%, kind of like a home equity agreement. And there was no payments, there was no time frame to pay it back. But if you ever refinanced or ever sold the home, then the state would get its money back. That program ran out in like 24 hours, so that didn't last too long. But I know I'm sure other states have had programs that come up like that, and until in California, they will probably bring it back if they get the funding for it. Right now, California just doesn't have money, so I don't know if that's going to happen anytime soon. Um, but there's a lot of programs like that, and also programs for getting your property fixed. California, and I know a lot of other states are doing this too, are really pushing ADUs right now. So ADUs are a big play, and there's been a lot of grant money that you can get for building an ADU on your property. And I think at one time they were up to like $100,000 in grants that you could get, and that could go towards your engineering plans. It could go towards permits. It could go towards the actual build. Um, they also had some special loan programs. So again, this is going to be state specific, but there's a lot of like special loan programs they have for ADUs where you can get like super low interest rates, and they had some stipulations where it was a different, or no, it was they would forgive every monthly payment that you had, that you qualified for HUD housing. So if you had a low income qualified tenant, so you're kind of giving up on the rent side, but then they would forgive the loan each month that you had a qualified tenant in there. And I think you had to do it for like 10 years to get the whole thing forgiven or something like that. I think it was a 10-year loan, and then once you satisfy the 10 years, then you were good and you could start renting it for however much you wanted. But there's a lot of like programs that have all these different little quirky things, but there's ways to get this grant money and these loans forgiven for doing ADUs. And this is probably just in markets that have housing issues. So California is obviously one of those. Some of the larger, metropolitan areas. I know Seattle is another one that's big on ADUs, so they probably do those programs up there as well. Anybody here doing ADUs? Pip, you got anything with ADUs? No. We are working on one. California just passed this law, or this new assembly bill last year, where unpermitted ADUs that were built prior to 2020, you can get them permitted now without having to go through all the normal permitting process and having to get everything approved. So you kind of skip all that as long as it passes health and safety code. They just give you still have to submit plans, but you can get this. We have an ADU on one of our properties that was built in the 90s, and definitely not to code because it was too close to the fence at that time. They've moved the setbacks to allow for shorter setbacks now, but we're actually in the process of getting that retroactively approved. So we'll see where that goes. Okay. So, what's
Sorry,
up?
are there a lot of in California? Are there a lot of communities with with HOAs?
In the newer communities, yes. In the older communities, no. So like we live in Costa Mesa, and there are very few HOAs here. Everything was built in the 60s. Like most of the city was built in the 60s, and it was all
Right.
just farmland and whatnot. So it's just kind of like standard neighborhoods. But then you go a little farther south, like Aliso Viejo, and I think that's like 100% HOAs. And they also have Mello-Roos. So they have 30-year Mello-Roos fees on top of their HOAs. That's how they funded the city. Basically all the parks and everything was paid with these Mello-Roos, which I think are actually coming to a close. That most of that stuff was built in the 2000s, so I think that the Mello-Roos are almost done. But it's really just depends. So Irvine's another one that's got a lot of HOA communities. It's just kind of hit or miss, but it's really city specific. You guys have a lot of HOAs out your way?
Yeah,
Yeah.
HOAs don't like ADUs.
Yeah, that makes sense. All right. So then I wanted to jump over into more creative finance stuff, and then we'll kind of open up for your questions, Q&A. We've done quite a bit of creative finance in our acquisitions, and there's a lot of different ways of doing that. So One is just getting a seller to seller finance, and basically what that means is, somebody owns a property, they own it free and clear, and they just become the bank instead of you getting a loan, traditional loan, and buying the property from them. You just negotiate with the seller to carry the note, and you're just making payments to the seller. We've got one that we did. We bought last October, well, October 2023. That was a seller finance, and people say that that stuff doesn't exist in California, in expensive markets, but it's not always true. We got a property we bought for 1.25, and we got that with seller finance, and we only had 10% down, and we got 6% interest only for 5 years. So it ended up being a lot better deal because I think interest rates at the time, end of 2023, they were like hovering around 7%. So we were able to get a much better rate through seller finance. And usually, I mean, you don't always see that, but we also got lower down payment than we were expecting because this house needed a lot of work. It was half demoed when we bought it, and to get a lender on it, it was going to be a combination of an acquisition and a construction loan. And so we ended up getting it with 10% down versus like, I think it was like 30 or 35% down they wanted. We were cross collateralizing another property to help satisfy that, but it was still going to be a lot more cash. And the other lender had some really high origination points. We were able to avoid the origination fees. There was no realtor involved, so there was no realtor on either side. So the sellers saved money on that, and so they were happy. And it was a property that was in a trust, and the mother had passed away 4 or 5 years prior, and they were just using the property as a kind of a crash pad when they were in town. It had some water damage that ended up having, I think there was like 2 or 3 of the rooms were demoed. And so it was kind of half demoed already, but it was built in the early 60s. It really needed to be completely redone. So they needed kind of a special buyer. You couldn't get traditional financing on this home. So it really needed to be like a cash flipper or hard money flipper coming in, or someone that was willing to take on a project. And we were able to do that with the seller finance. Fast forward today, we ended up getting a construction loan on that. We cross collateralized another investment property. And that's another thing you can do to get creative with your financing is if you have a property that's got a lot of equity in it, another way to tap into that is to cross collateralize that with another acquisition or a construction loan. In our case, we ended up not using the collateral for the acquisition. We just acquired it with our money down, and then we used the other property and cross collateralized that to secure the construction loan. So we were able to get a $300,000 construction loan using the existing rental property we had with that equity. So they put a lien on both properties. They put a lien on the one we had, and they put a lien on the new one that was under construction. So that the lender, it's a little bit more secure because the lender has two liens, but they're also farther down the totem pole because they were in on the investment property. We had a HELOC on that as well, so they were actually in third position on that. And it was a private lender, so you gotta not, this is not something that normal banks are gonna do, but when you get into these private lenders, they're a little more willing to take on some of these more unique situations. So cross collateralizing can really help with either your down payment or with your construction costs. And then we do have, we've done subject to, we have a property in Texas that a duplex that we acquired subject to. That one I think we got with we did have some money down. I think they were a little behind on their payments or the taxes or something, and they needed some money, or maybe they had gotten it caught up, but they needed money to pay the realtor because they had a realtor. But we got into that one. I think it was probably about 10% down. Got into it with a interest rate that was from like 2022 or early 2023 maybe. So it was like, I think it was like 4.5%. So it wasn't a great interest rate, but definitely better than what we see today. And if you haven't done subject to, anybody here done subject to before? No?
No, I have not, but I'm actually somewhat looking into it right now. I got this interesting opportunity locally to me. It's actually a friend. I know him, and
Mm,
I saw him put his property on the MLS, And I was like, oh, dude, you should have told me. Like, but he owns it with a partner. And
Uh,
the reason why they're selling it is because they do a lot of STR in the area, but they just outlawed STR. So he's like
oh,
trying to find ways around it. He has a few properties, but this one kind of just got outright like shut down. The city didn't want it anymore. So I offered him like, hey, I don't know much about seller financing, but I'm down to try it. And he said he's in, but his partner kind of just wants to offload it. But I guess I I read Pace Morby's book. I tried to like learn all these things in a very quick manner, but I'm still trying to piece it together. I gave him like an
so
offer, and it was kind of like a baseline offer, but I'm just trying to figure out how I can do it.
so you got to be careful with subject to. I'm assuming they have some sort of investment. Do you know what type of loan they have on it?
Not the exact type of loan, no, but I believe they owe around 300, and they listed it for like 600.
Okay, so were you gonna get like a second loan for the remainder, or are they gonna finance? Are they gonna sell or finance that portion to you?
For the equity that they have.
Correct.
I positioned it as seller financing, and I would pay them for the equity.
So
But
you're gonna take
I am
over.
open to,
So
yeah.
you were gonna take over the first position as subject to, and then have them sell or finance back the remaining equity.
That was the only thing I thought of. So I don't know if that's the best option, but that's where I'm at.
I mean, it's definitely an option. It depends on their bank. So you don't know what kind of loan they have.
No, I
Because
imagine it's something on the traditional side. It's probably a conventional or DSCR. But
okay.
I've talked to him about loans before. I knew like he didn't even know what like an FHA loan was. So I think he went the conventional route, but I'm not fully positive.
Yeah, you just want to make sure a few things. You want to make sure that there's no balloon on it. So if it is some sort of investment type loan, you want, you want to
Oh,
make sure
you're
it's not
saying
a
like an
balloon.
arm or
Yeah,
something?
well, even that, even an arm, but you want to make sure it's not a balloon because a lot of investor loans, like if they bought it with a DSCR, they're probably on a either a 15 or 30 year, so it's probably fine. But if they bought with like a private loan or a hard money loan or some sort of investor product, a lot of those will be like a bridge loan or something, and it'll be like a 3 year loan or 2 year loan. So
Hmm.
you want to make sure you're
That's
not
fair.
getting trapped in that because you get backed into that, their loan expires, and all of a sudden you have to get out of it. And if you can't get it refinanced, like it becomes a big mess. So you just got
That's
to be
fair. Yeah,
careful.
definitely,
You want to make sure you have
definitely
as
look into
much.
that.
I mean, if you take something subject to, you want to get it out of that is, in my opinion, you want to get it refinanced out of that as soon as possible, when it makes sense, right? Because do you know what their rate is on it? Do they have a pretty good rate on that?
Yeah, they have a great rate. They have 3% something, I think.
Oh yeah, that's probably a pretty standard loan in that case. But yeah, so you want to try to refinance when you can, but it's we may not see that rate again, so maybe a while before you see that. But it depends on what they give you on the seller finance portion too. So if you're not, I don't know if you've talked to them about interest rates on the seller finance
I
aspect
did.
of it.
I offered. I think I offered interest only year one, and then 4% interest, and then I spread it out over a 30-year period.
So wait, so interest only on the first. So what was the interest on the first year?
4%. I did 4%
Oh, okay.
throughout the whole period. Interest only year one, and then principal and interest after that. Um, and yeah, yeah.
Okay, got it. So one thing to be careful with here, and I'm just going to tell you this as you probably haven't run into this or haven't done this yet. When you're doing seller finance, so this is really more on the seller side, but as investors, I think that it's kind of our duty to make sure that people know about this because if people aren't real savvy, they're not going to know until it's too late. You right now, if you do, you can't actually do a four. It's not illegal to do a 4% rate, but the IRS is going to tax them or have tax liability based on the interest that they earn on the loan, right? So if
Hmm.
they're making 4% on that 300,000, they're going to have tax liability on that 400,000 because that's interest profit. It's interest income. The IRS says so. A lot of times you'll see people negotiating 0% seller finance deals. Investors will offer somebody literally no interest, and they'll make principal
Yeah,
only
yeah.
payments or whatever, or they'll have deferred payments or however they do it. But if you're doing something like that, the IRS doesn't allow 0% loans. They don't allow 4% loans right now either. it's not that they don't allow it, but you still get charged on it. So I think right now there's an index that you have to look up to see what it is. I think right now it's 4.7%. Anything below 4.7%, the IRS bumps up to 4.7%, and they say you have to make at least 4.7% on your loan. So I only bring that up because if you're at 4%, I mean, your buddies can do that, but they are going to get taxed as if they are making 4.7%, even though they're not collecting that income.
Yeah, I definitely did not know that. So thank you.
Most people don't, and a lot of investors either don't know this, and they I've gotten in like arguments and groups with people, and people will just push this on. Well, sounds like a seller problem, not my problem. Like, you realize that like somebody can have a huge tax bill, like in California with $1 million property. If someone gets 0% and then they get charged as 4.5%, like they could potentially end up with like a $10, $12, $15,000 tax bill on money that they never even collected. So that's why I think it's important to know how it works and just make sure that you're telling the people. Like for me, I would probably never offer less than whatever that index is. So you have to look it up. And Chris, I can send this to you later, but it fluctuates every quarter, or it might be every 6 weeks. It might go along with the Fed when they change the rates. But it's a specific amount. So whenever the loan is written, whatever that rate is at the time that the loan is written, that's kind of what it locks in as. And that's what the IRS is going to use for their tax basis. So just something to be aware of, because you don't want that coming back on you, especially if it's somebody you know and they come back on you and be like, "Hey, we're getting charged for this. Did you know this?" Like, I just think
I wouldn't do that regardless.
I just think it's more ethical to bring it up, no matter who you're buying from and who you're talking to. Like, especially if somebody's not financially savvy, like, well, they should talk to their CPA. Well, not everybody has a CPA. It's just like you should be bringing this stuff up and educating people, so that way there's no surprises.
Understood. Yeah, thanks for the advice here.
But yeah, no, that sounds like it could be a good opportunity for you, though. So no, that's good. I mean, that's kind of where in the Q&A call anyway, so you're good. But yeah, if you have any questions, like, feel free to like post in the community, and I'll see what I can answer on that, because we've got a little bit of experience doing those type of deals.
Yeah, definitely will. Sounds good. Thank you.
Yep. So just to clarify, like what Chris was talking about, it's kind of like a hybrid with subject to and seller finance, because if you got somebody that's got a property worth 600,000, their underlying loan is at 300,000. So if you take it subject to, meaning you're just basically taking the loan over that they have, you're getting the same, you're just paying the loan terms. You're actually taking it over as if, that loan was yours originally, but there's a $300,000 delta. So you have to pay the sellers that $300,000 and you got to either pay cash, or get a second loan of some sort on that, which is really hard to do. Or what a lot of people do is what Chris is talking about, and they'll do a seller finance and have the equity seller financed from the owners to Chris on whatever terms they work out. So he'd be making two payments, but they would both be at really good rates compared to what you see today. So it sounds like that could be a pretty good deal if it works out. Another thing that we've done is what's called a wrap, which is similar to kind of like it's like a combination of a subject to and a seller finance. But basically, if somebody has a loan in place, they actually seller finance the property with a existing loan in place, but they're making their own loan. So they're actually writing a loan from the seller to the buyer, doing seller finance terms, whatever that may be, and there's an existing loan underneath it. These are pretty complex, like, creative strategies. So like, you need to look into this and make sure that you've got everything done right and properly, and taking title of the property correctly, and making sure that everything is done legally. But there's a wrap, and I've actually done a wrap in California. We acquired a 14-unit apartment building with a wrap, got really good terms on it. That we acquired this almost 2 years ago. Got really good terms on it. And this one was really interesting. The credit union that has the underlying loan knew that the owner was wrapping it and selling it seller finance, and they were okay with it. I actually had to sign forms saying that we knew it was getting taken over, or like that we knew there was an underlying loan, so that the credit union knew that we knew what was going on. And then they also knew who we were. So they knew that someone was buying it, even though the loan still to this day is in the seller's name. So that's another strategy. And I think wraps are really big in Texas because of the way the laws are. I'm not sure, like subject to is a little trickier in Texas. So I think a lot of people will do the wrap versus the subject to. If you guys are interested in like subject to, I know Chris mentioned Pace Morby. Everybody knows who Pace Morby is. I think Pace Morby's under a little fire right now with all of the sub two deals going bad with these larger buyers in Florida. But there's another educator that's been doing this for way longer than Pace Morby. His name is William Tingle. And I'll post this in the chat. He's actually who we've had him on our show before. And yeah, here it is, sub2deals.com. I'll post this in the chat. But William and his wife, like they're super cool, super easy to talk to. We've done some courses and education with them and done some consulting with them. And he's got a podcast as well, a weekly podcast that you can learn a lot about. I learned everything that I know about sub two from William. So just listening to this podcast, he usually does an episode a week that goes into like one aspect of subject two, like how to find the deals, how to market them, how to talk to the people, the contracts you use, how do you deal with insurance. Like he'll do one of these little pieces each week and break it down. I know that they do a lot of radio ads. That's how they get the majority of their deals is radio ads, which is interesting that that's still a thing today. But in their market, I think they're in Georgia, or they were in Georgia, somewhere over there. But they do radio ads and they do really well with it, which is super cool. So subject to let's see, what else have we done? Trying to think of another creative. My wife's on the call now. Lauren, what's something else that we've done you can think of? Nope, she might not be listening. She's pretending to listen.
Sorry, the kids were screaming
No.
back here. I didn't even hear what you
Oh.
said.
No, I was just going over like the creative finance stuff that we've done, trying to think of any other. Oh, I guess we have done some other seller finance out of state deals where we'll put like 10, 15, 25% down or 20% down and just buying from another owner, kind of like the first one we talked about, but that one was in South Carolina. It was like a $25,000 property. We only put $5,000 down. It was $5,000 down and then financed 20,000 for 8 years. Paid that off, and we actually just sold that a few months ago. So we had that for 8 full years. All right. Didn't want to put through the grants. Oh, another thing I wanted to talk about is home warranties. This is a biggie. This is one that I don't know a lot of people other than us that do the home warranties. Usually when you buy a home, if you buy a primary residence, usually if you have a good realtor, usually the realtor will require the sellers to put a home warranty in place. And it's a 1 year, they give you 1 year, they pay for it. What typically happens is after a year, people just let it expire and then they don't get it again. And I don't know why people don't continue these. Maybe they just didn't use it that first year and didn't see the value in it. But we have home warranties on all of our properties. And here's the thing, like the rates go up every year. They try to go up on you every year. But if you call them and you just tell them that you want to cancel or that you need a better deal, they will always work with you. They want your money. We usually end up getting them for about half of what they normally cost. So I think on our properties, they're usually like between $400 and $600 per year. And you can do monthly plans on these. And we do that on every single property that we have in California. And I've got one property in South Carolina that has this, and multifamily. I don't think we were able to get on the multifamily properties, or you have to put it on each unit. So a lot of them, it didn't really make sense, but a home warranty, I recommend American Home Shield. There's a lot of them out there. Some of them really are crap, but the the American Home Shield is a really good one. They've been around the longest, and we've had the best luck with them. So typically, what a home warranty is going to cover, it's going to cover. There's different coverages that you can get. We usually go with kind of like a mid-tier one. Um, it's going to cover your major appliances, so like your oven, range. Usually, you can get a fridge that's covered. A lot of them have a washer dryer coverage. So water heaters, any of the normal like appliances that stay with a home are going to be covered as well. So your water heater, your HVAC heater, all of that, all the ducting, all your electrical, all your sewer lines, all your plumbing lines, all of this stuff is going to be covered. And you do have a service fee. It's usually, it depends on the location, depends on your market and which plan you go with, but typically the fee is $75 to $125. And that covers whether it's a simple fix or a really, complex fix. I've gotten several water heaters replaced this way. So $125 and we get, a whole new water heater installed. I've had HVAC systems replaced. I've had these long enough to where, again, maybe if you don't have anything that goes wrong for a year or two, you might think, oh, it's not really worth it. But then you cancel it and all of a sudden your AC goes out or your water heater goes out and you got a $2,000 bill on getting a new water heater installed or $8,000 bill for a new AC condenser. All it takes is one of those big items to go out and you just paid for that plan for several years plus anything else that came up. If you have an older house with older plumbing, that it's a really good peace of mind to have that in place, because anything that's under the slab, slab leaks, things like that, that's all going to be covered. We've had them have to break through concrete and cover stuff that was under the concrete. And so that stuff can get really, really, really expensive when you start breaking concrete and having to go subgrade like that. So all the stuff, and usually it covers everything that's in the footprint of the home. So if it's outside the perimeter of the actual home itself, it's not going to be covered. But if it's anything that's under the footprint, down all the way to the underneath the slab, it's going to be covered. So all the plumbing in your walls, all the sewer, all the electrical, all that stuff. So that's been huge. We've used that on several. We had a property that we bought that we lived in that had an old heater, didn't have an AC, had an old heater that was probably 50 years old. And we were waiting for it to go out because we had this home warranty and the darn thing wouldn't die. I thought it was dead because it stopped working. I was like, this is it. We're gonna get this covered. And called the guys out, and the guy said, oh, he's like, I don't think this thing is going to work. This thing is so old. And he's like, well, there's one part I'm going to order. I have to at least try, or else we can't write it up as a total failed unit. And ordered the part, and the darn part worked. It came in like a month later, and this old part that he somehow found actually fixed the problem. So we unfortunately didn't get to use it on that one. But I have had other full AC units that have been covered. And like I said, several water heaters. Like the water heater alone, that covers 2 to 3 years of what that warranty costs just right there. So that's a big one. And we do this on the investment properties and primary residence. I would say the investment properties, we probably do it more so than the personal properties, because we do it on both, but I do a lot of repairs ourselves on our properties. But the rental properties, it's nice to have something pop up and maybe it's a $200, $300, $400, $500 repair, but now we're only paying that $125 service fee each time there's an issue. So, if you have one or two of those a year, you're money ahead by having that warranty in place. So just be careful that you are getting a good one. Again, American Home Shield is the one that I recommend and that we've always used. We've used several different ones and we always come back to American Home Shield. They are a little more expensive, not that much more expensive, but they're just such a more solid company that it makes it worth it.
I have a question on that.
Yeah.
Usually if something breaks, like, do you have to use whichever contractor that they send out? And what is usually like the turnaround time from like requesting someone and having someone come out?
Yeah. So typically you would actually start the claim with them and you can just do it online. And they will send out their their contractors. I've had it done both ways where sometimes it like, so what I like to do is I will look up the contractor that they're assigning. And if that contractor has really bad reviews, because there are some contractors that are only contracted with like a plumber, for example, is only contracted with home warranty companies, and they might be contracted with all the home warranty companies, but that's all the work that they do. And there are some of them that are really bad. So you'll go and you'll look at their Google or Yelp reviews, and it'll just be like 1 star and be like, home warranty company sent this out and this guy was terrible and this and that, and you'll see like all the complaints. When it's one of those, I tell them I'm not going to use this vendor. They got terrible reviews, blah blah blah. They will reassign it, and I will look and see who they're reassigning it to, and make sure that it's a decent contractor. So I'll look it up on either Google or Yelp. And as long as there's somebody that I would feel comfortable calling and bring to the house, then they'll go and do it. You can, like, they prefer to do it that way. You can, if they don't find a contractor or can't get anybody out fast enough, you can actually use your own contractors. But you have to pay for it up front, and then you have to submit it to get it reimbursed. And it's a lot, I would say it's a little riskier because there's a higher chance that it's not going to get covered if your contractor doesn't submit the right stuff and everything that they want to see. So I always use their contractors, but I do make sure that it's a good local contractor that's got good reviews on the public side. So people that are actually using them. And usually the better ones are ones that also deal directly with customers and have kind of a better reputation. So yeah, so definitely I would, be careful of that, because there are some bad companies out there that are just contract only with these companies, and they tend to not have very good customer service. Hope that helps.
Well, thank you.
No problem. All right. I got a couple minutes here. Any last questions on anything?
Beckett would like you to say hi to him.
Oh, hi, Beckett. Hey, buddy. Good question. Good question. All right. I think that's it for today. I don't know what we're doing next week. I'll try to get it out a little sooner. I kind of want to do an AI call on how we're integrating AI into all of our businesses. But if anybody else has a specific topic, feel free to post it in the community, and we can try to get that on the schedule as well.
Thanks, Josh.
No problem, guys. All right, guys, take it easy. Have a good one.
Appreciate it. Bye.
Thank you. Bye.
Hi, Daddy.
Bye, guys.
Love you.
Love you.